Today I'm going to go over what are options. So if you hear of an options contract, that's effectively 100 shares of the underlying stock or ETF. So when you buy a call option, you have the right but not the obligation to buy the stock or ETF at a given strike price for those 100 shares. If you sell the call option, if the buyer says that they want it and they want to execute that option, you have the obligation to sell that stock or underlying ETF at the given strike price. If you have a put option, you buy the put, you have the right to sell the stock at the given strike price you've agreed upon in the contract. If you sell a put, you have the obligation that you have to buy the stock at the given price. So basically, this is the buyer putting the stock onto the seller at a certain price. When you buy something, you can either buy to open or buy to close. And again, when you sell, you can open the contract or you can close the contract. So the reason why you want to do that, sometimes the underlying stock price goes very high or very low and it's so far outside of the money, it's very easy to buy it back to close or sell it to close that contract, and it gets rid of the risk that it could be basically executed at a later date, but you might do that at a very low cost. Contract expiration dates, basically that's the last day the contract can be executed, and it'll either be in the money or out of the money. We'll go through that in a second. So a strike price is basically the agreed upon dollar amount per share for that contract. And your contract premium, that's the price of the option. So if you're buying it, that's the price you pay. So a couple other things with options, if you ever hear of the Greeks, these are the Greeks. Basically, this is going to cover how time decay, price, and volatility change the value of the option over time. So delta is basically the price change per dollar away from the real stock price compared to the strike price. If you're really close or you're in the direction you want to be in the money, this is the probability of being in the money. So theta, this is time decay. So as soon as you buy an option, this theta starts to go down every single day, and as you get closer to the end date, it really disappears quickly. If you're a month away, you have more value because there's more prices that could change and it could go in your favor. As you get closer to the expiration date, you have less and less time available to have some type of swing that puts it into the money. Vega is basically the measurement of volatility. If the specific stock or the overall market, people are worried or they're exuberant, and basically stocks are going either very high or very low and they're making wild changes, that's going to have a high impact on the volatility, which will then put more value into an option. If you're buying options, you want to generally buy options when you have low volatility, because you're not paying as much premium for Vega. But if you're selling options, you want to have a ton of volatility because that puts a lot more premium on the specific stock that you have. Gamma is a little hard to understand, but this is the rate of change of delta. So if delta is the probability of being in the money, so that dollar change per dollar from the strike price to the real stock price, this would be the rate of change. Like, is this, if I get into being in the money, what's the probability of staying in the money? So is this a stock that goes wildly into and out of being in the money or out of the money? Or is this something that is relatively stable where wherever it goes, it doesn't change that rapidly and it just stays there? So this is more the stability of being in that spot. And what do we mean by in the money? So I'm going to say this a couple of times, but in the money, basically your strike price is in a favorable condition compared to the underlying security. If I'm buying a call option, I say my strike price is $100. If the stock price is now greater than the 100, it's in the money. Less than 100, out of the money. If it's equal to 100 out of expiration, then it's at the money. Options can be good to hedge against loss, especially on the downside if you want to put options. If I feel pretty strongly about something, I can buy a lot of options, and those options could give me all the upside potential. The only thing that I risk is whatever premium that I put in there. And again, it might be about 80% of all options expire pretty much worthless. We're going to take the SPY, the S&P 500 is about $480 a share right now. And we're going to say the strike price, we're going to call that at the money, meaning at the price that it currently is at $480 a share. Well, if I say I want to buy one option or the right to buy 100 shares in the future, which would be 60 days from today, similar to the closing, that's the contract expiration date, how much does that cost? Well, the premium here would be $11 a share, times 100 shares is $1,100. That sounds pretty similar to over here. So if you look at here, we have earnest money, basically a premium for us to have the option to buy the home in about 60 days. So we take that 60 days and that's your contract term. How much would I be buying this if I actually bought it at $480 a share? Well, times 100 is $48,000. So you see how these are similar. Now again with this, the buyer has the right to buy the stock. The seller has the obligation to sell the stock. Premium on an options contract, that doesn't go towards the cost or towards the price per share. That's just the premium that the seller collects. So this is the big takeaway. If I bought the stock, I'm risking $48,000. In this instance, I would have lost $8,000. If I bought the option and took that loss, I will have only risked the premium I put up, that $11 a share or $1,100. So that's a very small risk, but I have unlimited upside potential. If you're looking to gain more financial education, I cover a lot of things that are stocks, bonds, how to invest, how to get out of debt, how to save money, how to buy a house, those sorts of things. If any of those interest you, please subscribe and have a great day.